Welcome to the Money and Mortgages podcast. I'm your host, Adam Coleman, accredited financial counselor and mortgage planner. Join me as I speak with fellow industry experts on all things personal finance. Welcome, everyone. This is Adam Coleman, and today we're going to be talking specifically about Roth conversions. So with me here to help explain all this stuff is Bill Nugent, a certified financial planner and founder of Convey Wealth Management. Bill, thanks for being here.
Thanks, Adam. Glad to be here.
Well, I appreciate you taking the time. Before we dive in, I guess tell us a little bit about yourself and your firm.
Yeah, so I'm here in Los Angeles. My wife and I moved out to the West Coast from the Boston area, went to school and grew up in the Boston area. Moved out to the West Coast 20 years ago, and I've been doing financial planning since the late 90s. Started my own firm a few years ago with a focus on tax strategy and planning. In the prior iterations at companies, I worked for Fidelity for a long time and a few others, and there's a lot of things they can do, but they can't help with tax advice or estate planning. So I really enjoy the ability to sit at someone's kitchen table, and whatever the topic is, I can handle it and bring in experts that can make sure that the job gets done. Folks like Adam to help with mortgage planning and other topics. We have a 9-year-old son, and we're getting ready for Little League season, which starts next week. So we're hoping it stops raining here.
Nice. Well, no, and I thought it would be good to have you on here just because you do have that tax planning background, and that's big, obviously, on Roth conversions, and we'll talk about that more in detail. But I guess diving right in, can you summarize for everybody that isn't really familiar with what Roth conversion means? Well, what exactly is that?
Yeah. So what a Roth conversion is a transaction that a person would make in an effort to maximize their after-tax wealth, either for themselves or for the next generation. Traditionally, people contribute into IRAs and 401ks and different investments that are tax deferred. And the deferred is the important part. You're not getting away from the taxes, you're just deferring them. So what a Roth conversion does is it actually, in a strange way, accelerates those taxes. But in the planning, essentially what we're doing is comparing, if we take a tax hit today by converting, what is left over and how do taxes look in the future. And oftentimes there is an opportunity to create a tax-free position, not only for a client and maybe their spouse, but it's also a huge benefit and a bigger benefit to the next generation. Upon passing, all those IRAs and traditional 401ks are taxable, and currently a beneficiary would have 10 years, if it's the non-spousal beneficiary, would have 10 years to take all that. And so for a lot of clients, they picture, okay, if I'm gone, let's say my kids inherit this money and they're in their 40s or 50s, they're at their peak earnings years. Now all of this money gets thrown on top of the earnings that they're already bringing in, and thus their taxes go through the roof, and we end up with their rates being much higher than the client's rates today. So that's a sort of a quick intro, but it's really about looking at taxes now and in the future. So there is a bit of, I don't want to say guessing, right? But that's really what we're looking at, is sort of comparing what we know to be true today versus what we think will be true in the future.
Nice. Now, there's certainly a little bit of guessing involved on tax brackets. That's just one thing nobody's really going to know yet. So you spoke to some of the potential benefits. So I guess the main thing would be, when should somebody really consider doing this? Is there more of an age component, or is it really more driven towards income levels for that particular year?
Yeah, the age is part of it. Income is a bigger part of it. I'll give you an example. A client I spoke with yesterday, he has significant assets in 401k, as does his wife. They are in their late 30s, and he's starting a business. So their income this year is way, way lower than it's been in the past few years when he was working at a company and bringing in a 6-figure salary. So it's early in the year at this point, and I'm hopeful that his business does well. But if a lot of businesses, when people start them, they don't make a ton of money early. So this could be a good year for him to look and say, hey, in 2024, in the future, he'll look back, 2024, the year when I started my business, I was in a low bracket because I didn't bring in a lot of money. So by converting some of that IRA and 401k money now, while he's in a low bracket, he pays taxes this year. And in the future, when his business is flourishing and his income is much higher, this money will already be over to the Roth, and thus he won't have a tax bill to pay in the future upon withdrawing the money. and God forbid something happens to him, it goes to the next generation, they don't pay anything on it either. So it's a real asset with, to get the IRS out of that future growth. More commonly, where we see it is at retirement. For someone retiring, there's often a window between their working years and the IRS mandated withdrawals, which typically start in your early to mid 70s, where during that window, you have years where your income drops significantly. That's often the sweet spot for running those calculations to see what sort of conversions would make sense.
Gotcha. I guess, what do you consider a low tax bracket in this example?
Well, I mean, it's really not necessarily that there's one that's low or high. It's more a comparison. So if somebody has been in a certain bracket and then due to retirement, they're going to be down to a much lower bracket. Again, traditionally, what people generally do with taxes is they don't want to pay it any sooner than they have to. They think of it like any other bill. So they live on all their after-tax money. They live on rental income. They live on other things. And so as they get into retirement, those 401ks are not being taxed, and thus then you can look, and that's part of the software we use. We actually forecast and say, what if you did nothing? Let's look at 73 or 75, whenever, depending on your age, your required distributions kick in, and then look at the state and federal taxes at that point. And then sort of look at, okay, that's where you'll be. Let's look at where you are now, and it's about the delta. We sometimes see people where they're going to be in a high bracket no matter what. So then it's a little bit less of a concern. Or for someone that maybe is going to give all their money to charity, well, then the tax rate to kids or grandkids doesn't matter because there won't be one. So there are, like a lot of financial decisions, right? It's a perfect idea in one case. I always say with clients, and I actually teach financial planning over at UCLA. And one of the things I'll talk about is they'll say with investments or tax strategies or things, they're all good. It's not a matter of whether it's a good idea. It's a matter of whether it's appropriate in this situation. So it might be a wonderful idea for this client, and for this other client, it's a terrible idea. So that's where the individual customization comes in.
It's a good problem to have if you have tons of money in any of these accounts. You're just trying to fine tune it a little bit so you're not paying as much in taxes long term. So
absolutely.
Well, are there any situations where, and we kind of spoke to it a little bit, but any situations where the Roth conversion wouldn't be advisable?
Yeah, if you're in a situation where you're going to be in a high bracket in retirement, I have a client who owns 8 rental homes. So for him, the conversion decision, he's actually still decided to convert, knowing that he's got enough income, he's not going to touch it. So for him, it's a matter of where am I at today and where do I want my daughters to be? So he's got young daughters. And so when he's gone, he's going to give the money to them, and he wants them to just take it tax-free and be set to go and to do whatever they want with it. But if it were just a financial decision, again, it's based on the income brackets that you wouldn't want to elevate yourself and make your taxes worse now than they would be potentially in the future. So it's really about that calculation. If you're already in your 70s and you're already taking those distributions, these conversions, remember, taxed as ordinary income in the year that they occur. So you do have an additional tax bill that you're generating by making the conversions. I sometimes get people say, oh, I want a Roth because it's tax-free. Wonderful, right? That's great. But to get there, you have to pay a pretty big tax bill. So it's a matter of looking at what that calculation looks like and seeing if it makes sense. There was a rule up till 2017 where you could recharacterize. So you could do a conversion and then change your mind. And so where that worked out, people were gaming the system. They'd say, I'm going to take $50,000, let's say, I'll convert 10,000 and put it into Amazon stock, 10,000 to Microsoft, 10,000 to Tesla, split it to different stocks, and then keep the ones that did well, and the ones that didn't do well, let's throw those back in the IRA. So it was this way to kind of bet on the game after the game had ended, right? Which the IRS didn't like. So they get rid of that. So now Roth conversions are not reversible. They can't be recharacterized. So as a result, we generally like to do them late in the year because we want to know where you're at for income. November, December, we can look at where you're at and come up with a pretty good idea of where your bracket's going to be to see if a conversion does make sense in that year or if we should hold off.
When's the latest you can do one? Is it all the way up through the tax deadline, or is it year end?
No, it's year end. And there are strategies. One of the common strategies that I work on with my clients is if we are going to be making a conversion and generating a significant tax bill, to also maybe pair that with a charitable donation to a charitable gift fund or donor advised fund. There's different names at different companies, but it's essentially a way to put money towards charity, which cuts your tax bill. So we look at the effect of sort of start with, what if we did nothing? And then we say, what if we did a conversion? What if we did a conversion and paired it with a charitable contribution, and just sort of really work through those numbers and get into, again, the tax effects of making these decisions. And as a fiduciary, I'm not here to sell anything. I just say, hey, here's how it would look. Based on the numbers, this is what makes the most sense. So I'm doing a lot of the research, and I work with a lot of CPAs. And CPAs are wonderful people, but they're often very, very busy. And so strategy and future projections and things aren't generally something they spend a lot of time on. So I can do a lot of the strategic work around sort of the planning piece. And my clients often say, well, let's run it by my CPA. So we'll set up a call or a Zoom and run through the numbers. And usually they'll ask a few questions, but they'll say, hey, sounds good, right? It's just something that they don't generally spend a ton of time doing. They get paid to file returns, so that's what they do, which is what they should really focus on.
What are the main documents that the CPA would need after they do a Roth conversion?
So the Roth conversion generates what's called a 8606, which is an IRS form. And in section 2, you report the amount of those conversions. Another important piece that doesn't matter from a tax perspective, but it is an important consideration, is in this process, if you're going to convert, what do you convert? Do you convert shares of this fund or that fund or individual stocks? In your IRA, you might have all kinds of different things. And so in general, what we would convert is the most aggressive piece of the portfolio. So if we're converting a certain amount, well, again, first determine the amount and then say, okay, it's $20,000. Now let's look through the positions, because you can actually convert in kind. You pull X number of shares of Tesla or Amazon or the Vanguard 500 fund, whatever position you want to convert over into the Roth IRA. And then generally, that Roth IRA is your most aggressive bucket. So that should be, in most cases, 100% stock at all times, because it's going to grow the fastest. It's never going to get taxed to you, and it's never going to get taxed to future generations. So we also do some work around what they call asset location, which is asset allocation we're all familiar with, is, how much to put into stocks and bonds and cash. Asset location is, well, what should I own in my IRA versus my Roth IRA versus my taxable account? So in this process, if you're new to the world of Roths, you generally look at that Roth piece as your most aggressive bucket. And then if necessary, we actually will take the risk down on the IRA or taxable accounts to keep the overall balance of the account even.
Nice. You mentioned that sweet spot there where it's kind of the retirement age up through the time where you're starting to get required minimum distributions or Social Security. Can you maybe explain why that's such an important time to really consider Roth conversions? Because people might just generally think, oh, I'm spending about the same, so I'm going to need the same living expenses for my entire life. Why is that spot so important?
Yeah. So when you get to that point, you have income that stops. You have some bills that kick in, health insurance, maybe long-term care insurance, other things. A lot of times your mortgages are dropping off or getting smaller, if not being totally paid off. So you're in a changing spot. You're spending a lot more on entertainment. You're spending a lot more on vacations. You're going to see kids and grandkids, so there's a varying range of sort of what we call lifestyle expenses for each client. And so in general, your income is going to drop for most people, and thus you're going to end up in a lower bracket. It also wraps in, when should I take Social Security, which is another consideration. In general, the later the better. The numbers would support that you would make more having waited. That being said, the majority of people take Social Security early, so that we can do a whole other show on Social Security. But that period, when you hit your required minimum distributions for your IRAs, your 401ks, your pre-tax, tax-deferred accounts, they can kick in at 73 up to 75, depending on your year of birth. And then the IRS is forcing distributions of roughly 4% of your balance. So if someone has a significant amount in pre-tax money, all of a sudden They're now in their 70s. They have one, maybe if they're married, two Social Security checks, and now a significant distribution that they have to take whether they like it or not. So a lot of times their tax bracket jumps considerably. So if you retired in your, say, mid to late 60s, you could have 4, 5, 6, 7 years where you're in that lower bracket. We can take some of those conversions, shrinking that pre-tax balance, and thus your distributions at 73 or 75 become significantly smaller. So it sort of it accomplishes, it's like a domino effect, right? It helps with the income, it helps with the inheritance, it helps with the future taxes for yourself. So there's a lot of different effects to it, which is where it helps to have kind of a comprehensive look at all the different factors.
Right. Well, and correct me if I'm wrong, but basically the main concept is you're just trying to fill up as much of the smaller tax brackets on the marginal tax bracket as you can. So you're just trying to, there might be years where you can live off of capital gains and there's just not that much capital gains income that you're having to report. So you're really at the low end of the marginal tax bracket. So you've got this window of opportunity where you can start using that and still only maybe pay the whatever the effective rate is, like 10% or 12%, if you can take it all the way up to that upper end of that smaller tax bracket, right?
Yep. Yeah. And then there are cases where it makes sense to even bump into a higher bracket if it's
Right.
still going to save money in the long term. So someone who maybe works for a company where they have a significant, maybe you were there for 30 years and you might have 7 figures in your IRA 401k accounts. So those distributions are going to be significant. So
Right.
I have, I've had clients with several million in 401k assets, and thus those distributions in the future are huge. And again, it's also a matter of where the money's going to go after, right? If it's going to go to kids or grandkids, then you also want to think about their tax bracket and their situation. And there's things called qualified charitable distributions, which is when those distributions kick in from the IRS, you can force or directly give up to 100,000 straight to a charity, and then it does not affect your taxes. It doesn't flow through to your bracket. Doesn't affect the rest of your income. So that's a solution for some people. So there are a lot of different ways to do it. So we're not here to say Roth conversions, as I said earlier, are perfect in every situation, but they can be very powerful and in a way to really see a significant delta in terms of the tax bill if we don't do it, and a tax bill if we do.
So we've talked more generalities now. Like, what does the actual process look like? Just nuts and bolts. Like, somebody has to actually think about doing that. Let's say it's towards the end of the year when people are really kind of starting to focus on this. What are the step-by-step steps they're actually going through to actually make this happen?
Yeah. So the process, you would go to the company where your money is. So let's say it's Schwab, Fidelity, Vanguard. You have your money that's there, that's in an IRA account. If you don't already have a Roth IRA, you would open a Roth IRA account on that company just to make it simpler. And then once that account is open, you can transfer funds from one account to the other, and it will ask you, is this a Roth conversion? And then what do you want to move? And you can indicate the number of shares and which actual investments you want to move. And you'll do it that day, and you log into your account the next day, and you'll see the assets are now over to the Roth side. And the value upon the conversion is what matters to the IRS. So there are years, 2022 comes to mind, where intra-year, in the middle of the year, say May, June that year, the market was way down. If you had converted then, and then the market rebounds for the rest of the year, you're good. You did your conversion. So the value there, it's not the value at the end of the year, it's the value when you did the conversion. So, last year, if someone did a conversion in October before the big run up in November, December, they would be psyched because now that significant run up in the market is on the tax-free side. So it's just a matter of opening the account, which is free at most companies. There is no account fees anymore. And then moving the funds over is typically done online. You could go into a branch if it was Fidelity or Schwab, they'd be happy to help you. Vanguard, of course, you're on the web or maybe on the phone, but it's not a tough process to handle logistics wise. It's just a matter of figuring out how much you want to move and which shares you want to move.
Is there really any kind of decent mechanism that you know of that like a DIYer can really do to kind of map this out? I know you use financial planning software that really maps it out completely for you, but
Yeah.
what do you see people do that aren't or don't have access to that software?
I mean, you could figure looking at your brackets and then looking at today. I mean, the tax brackets typically go up by the cost of living every year. So what your tax rates are going to be in 10, 15 years, you can sort of guess and come up with, if you took today's brackets and just ran them forward with a couple of percent inflation, you'll have a decent idea of where you'd be in the future. And then you can look at your IRA balances and run those with a projection of what you think the growth would be. So then you would know, okay, when I'm in my required distribution period, if my balance is, for easy math, let's say if my balance is going to be $1 million, I'm going to have to pull out about $40,000. So you can then say, okay, if I add that to 2 Social Security checks and whatever other income I might have, what bracket am I going to be in? And then compare that to where am I today? You know where you are today because you can look at your brackets and things now, and you can run that sort of comparison report. And so you could do it with, some Excel spreadsheets or, a notebook and a calculator. So it's not impossible to do. I know I'm old enough to have started in this business when that's exactly what we did, right? We had note paper and we'd sit with clients and figure this stuff out with calculators. But the software, there are some free programs online that you can use that would help in terms of running those projections so that the world of fintech, the financial technology stuff that's online is getting better and better every day. So a lot of different programs. If you looked it up online, you could probably find some good solutions that would help as a DIYer.
Which software do you use for your
I
firm?
use Right Capital,
Yeah.
and
Okay.
I've used Money Guide Pro in the past. I've used Navaplan. I've used several different ones. So there's a lot of different software out there, and it's all good. It just has different pros and cons. For me, I like Right Capital. It does a good balance of complexity, but also uses a lot of images where it's easy to tell the story instead of other software that spits out a giant Excel spreadsheet. It's easier to look at a picture for most people and kind of get the concept and the idea.
Well, and you alluded to this before, but in terms of asset allocations that you're thinking about converting over,
Yeah.
you mentioned obviously going, more aggressive in the Roth. Is there any other logic behind anything, or are there any other choices that you typically make with clients in that regard?
Yeah, I mean, it's really with the Roth, it's the aggressive piece, and then where the overall risk and the asset location kind of conversation is really just based on your future tax bill. So for a lot of people, you'll go through a questionnaire and it'll tell you you should be 60-40. And so they'll set up their IRA and their taxable and their Roth all 60-40 and say, hey, I'm good. But when you look at the tax bill on all those, that's where it doesn't work. So your IRA, 401k, your tax deferred stuff is the most burdensome, let's say, for future tax bills. The IRS is going to come after that, whether it's you or next generation. So that typically is maybe a third of the money that's going to disappear to the IRS if we're just using round numbers. Your taxable accounts are tax capital gains. So that's typically 15 or 20%. And then whatever state you're in, each state has its own unique rules there. So it's a better tax rate a lot of times while you're alive. When you pass away, according to current law, everything gets stepped up in basis. So your kids or grandkids inherit stocks, real estate, and other capital assets. They don't pay anything to then liquidate those. So those are better. And then the Roth are the first place, right? Because there's no taxes for you while you're alive or for the next generation. So when we think of it that way, what a lot of times we'll do is, again, overweight the risk on the Roth IRA and the taxable and decrease the risk on the 401k and IRAs. I have one client now, we have 100% cash and fixed income in all of their pre-tax accounts, and we're 100% stock in their Roth and their taxable. And their overall works out to about 60-40. So for them, the overall risk they're taking is balanced, yet account by account, it's very different. And that's, again, part of the getting into the nitty gritty of, the taxes and the investments and things.
Any other tax considerations or implications that people need to keep in mind when they're thinking about doing a Roth conversion?
No, I think it's again, it's a matter of where are you today? Where do you expect to be in the future? and coming up with the best, most educated guess really is what you can do, because they're going to change the rules like they always do. I mean, people get very excited, let's say, about changes in the tax code, and they change the rules. Yeah, they do that about every 3 to 5 years and have done so for decades, right? And so different people get into Congress, different people get into the White House, they change the rules. 5 years go by, different people get in and they change the rules again. So when you start to look at it, that's where it's also helpful, if you're working with an advisor or if you're doing it on your own, that you're staying up to date, listening to shows like this where you're getting the latest updates, because the way that maybe you used to do it may not be the best idea currently. So we're all hoping that they'll change us in California. We have really high state taxes. So the SALT deduction rules that changed a few years ago were a big hit to us. So we're hoping that they get some relief there. Give it a few years, maybe they'll change that. We don't have a state level estate tax here, but many states do. So there's always a moving target in terms of your taxes.
Any real world examples that you can think of where it's really come into play and saved people quite a bit by doing the Roth conversions?
Yeah, I mean, we have a scenario right now where we're working with a gentleman. He was an early employee at Apple, and he worked there, got a lot of stock options. So he has significant wealth built up, and he's got IRA, he's got 401k, he's got a lot of money that's on that tax deferred side. So in the case of running these projections that he's going to be converting, he's been converting 6 figures a year, and he's in his late 60s. So he's got a few more years before the IRS comes after him for required distributions. So in the case for him, we're now pairing those Roth conversions with contributions to a donor advised fund. He's giving some of that low basis Apple stock into the donor advised fund. So he's getting a tax deduction as well as generating taxes with the conversions. And the results on an ending after-tax basis are going to be 7 figures in terms of the taxes saved to both him and his wife, as well as to their kids over the life of the account. So his is an extreme example. It's usually not as stark as that, but it's often in the mid to high 6 figures when you start to think about the fact that if we can save you 10, 20, 30 grand a year starting in your 70s and run that forward for 20 or 30 years, it's a heck of a lot of money. So it's definitely something that's worth looking into. And it's funny too, again, being a fiduciary, I don't get paid off of selling any products and things. So in this process, if you can imagine, here I am managing someone's account, and by doing these conversions, I'm having them pay more in taxes. So in effect, I'm cutting my pay because I'm shrinking their accounts. But again, it puts them in a better situation later on. So I'm fine doing it. And again, when you explain that to a client of, hey, not only am I not getting paid for this, I'm getting paid less if you do this, and I still think you should do it. It really does to kind of drive home the power behind it.
Well, no, this has been perfect. Well, I appreciate you going through all that. I think we covered most everything that I was expecting to on this. So I appreciate you taking the time. If somebody wants to learn more about you and your firm, what's the best location?
Yeah, so I'm Bill Nugent. I'm on LinkedIn, and I also have my firm Convey Wealth, which is just www.conveywealth.com. You can take a look there, and there's a link there if anyone wants to make an appointment for a phone call or a Zoom, and I'm happy to help.
Nice. Well, I'll make sure to put the website in the description, and certainly appreciate you taking the time. It's always a pleasure to talk to you.
Thanks a lot, Adam. Have a great day.
Thanks, Bill.